Keystone Financial Group. So glad you took some time today to be a part of our webinar, our monthly webinar series. And today we're going to talk about the first quarter. A lot of different things that are on the minds of a lot of investors. And so we want to talk through some of those things. And hopefully you'll get a better idea of where we have been and where we are going. So let's first talk about three key themes that are on the minds of a lot of the people that we run into every day, whether it's our clients and we're doing client meetings or when we're out teaching and people just want to talk about these specific items. So first, is the progress of inflation stalling? Inflation is on the minds of so many people that we talk to. And is it stalling? What's happening with it? We're going to talk a little bit about those trends from the first quarter. Second, what are the potential implications of the Fed's next move on the U.S. economy? And then could the market participation broaden beyond the Magnificent Seven? So if you've been paying attention to the news, you know a little bit about those seven stocks that are referred to as the Magnificent Seven, and we're going to talk through what those are. So let's first look at a high level. How did the markets perform last summer? Or last quarter? So if you look at the S&P 500, went up 10.2%, pretty good growth. NASDAQ went up 9.1 and the Dow went up 5.6. So when you look at those three major indexes, you see growth in the first quarter. What about factors that may influence markets in the month to come? So again, interest rates, big topic that so many people are thinking and talking about. The Federal Reserve indicated that it expects to lower interest rates in 2024. Now, we're going to talk a little bit more about that, but the amount of rate cuts that they were anticipating has actually lowered. So optimism about lower rates is likely to fuel market growth, but if rates linger, investors may get cold feet. So we'll talk about some of that data and what we may see in the upcoming months. Economic data, investors will be closely watching reports on inflation, employment, other sectors for clues about future Fed moves in the economy's health. Recession indicators, forecasts have abated, but some economists think that interest rates could still trigger a recession. A lot of correlation with where interest rates go and what the overall market is doing. So if interest rates stay the same or go higher, that may have a negative impact on the markets. And then geopolitics, wars in Ukraine and Israel, attacks on shipping in the Red Sea. These are things that we're looking at and concerns that impact the overall economy. So let's first talk about what is happening with inflation. Is it stalling out? We knew in 2022 there was a huge spike in inflation. The Fed started making moves to cut rates last year to lower the overall inflation. And what we're seeing right now is inflation is pretty sticky, around 3%. And a lot of that has to do largely with shelter prices. Now, shelter inflation especially is sticky because these are things like rent. So when you're a landlord or you rent out a building or a home, more than likely you are not adjusting those prices day to day or month to month. So what that means is within the shelter inflation indicators, they're not showing in the overall inflation numbers because it takes a longer time for those numbers to reflect in the inflation. So falling market rents, they're not reflected in this data. And this is one of the reasons why you're seeing that inflation is stalling. And so over the upcoming months, we'll see, what does this mean? What is the Fed going to do and how are they going to react to the stalling inflation? Now, one of the themes that you'll see is we're in what experts are calling a Goldilocks economy. And what that means is the economy is not too hot, but it's not too cold. And so what the Fed, that has this balancing act of trying to steady economic growth and moderating inflation. And this can be very difficult to do because a lot of this is tied to how much they either increase or lower interest rates. So if the Fed holds rates high for too long, what happens is there becomes cracks in the economy. We can tend to move towards a recession and you don't see that market growth that we all want. If the rates are too high, people are not taking loans and buying things that stimulate the economy in a way that favors overall market growth. Now, on the flip side to that, if the Fed cuts rates prematurely or they do it too quickly, that's great for the market. It's great for market growth. But what we're going to see again is what happened a couple years ago, where the inflation reacceleration demand is stimulated. And so there is this balancing act that's very difficult, and trying to get that right balance so that we can have market growth, but not stimulate the inflation is what they're trying to do. And so this is very difficult. And what we're seeing right now is there is a stalling of the overall inflation. Now, the plan for the Fed was to cut interest rates 3 times this year. And we already know in May and June of this year, where there was supposed to be an interest rate cut is probably not going to happen. So we'll continue to monitor, see what happens, but this is a very difficult balancing act that the Fed is trying to walk. So could market participation broaden beyond the Magnificent Seven? So we talked about this before. The Magnificent Seven contains the 7 largest stocks in the S&P 500. These are Apple, Microsoft, NVIDIA, Google, Amazon, Meta, and Tesla. Now, if you've paid attention at all, you know that the significant growth in the market has a lot to do with these stocks. In fact, since the beginning of 2023, 2/3 of the S&P growth is specifically related to these 7 stocks. So I get the question all the time when I'm working with clients or I'm talking to people, and they say, why wouldn't I just invest in the S&P 500? Why do I need a customized portfolio? Well, the question that you have to ask yourself is, do you want a concentration in the S&P that's mainly these 7 stocks, or do you want diversification outside of these 7 stocks? Whether it's even within the other 493 stocks in the S&P 500, or even outside of the S&P 500 altogether. So as we look at what has happened in 2022, what we see is some of these stocks really performed poorly. And so they did some work, they recuperated, and now these stocks had an amazing 2023. What we're seeing now is Apple and Tesla have underperformed this year. And so what we're seeing is the market reflecting that with some of the volatility that we're seeing, especially over the last couple of weeks. So April, there has been some very volatile weeks that aren't necessarily reflected in the first quarter of 2024. So this is important data because what it's showing that is the leading US tech companies continue to offer some of the highest quality growth exposure. And what we're also seeing is some of this is because of the AI trends. And what experts are seeing is there may be some other AI opportunities outside of those stocks inside of the Magnificent Seven. So this is something to be aware of, watching these 7 companies, how it relates to the overall markets. But some experts are saying there could be some opportunity outside of those. So again, fundamentally, it goes back to the question of, do I want a concentration of a certain percentage stocks that make up a significant amount of the S&P 500, or do I want a diversification of stocks inside of my portfolio? Now let's transition into the upcoming election. This is on the minds and hearts of so many people. And it's interesting when I have conversations, even through reviews that I do, I'll get a comment where someone will say, man, I hope so-and-so is in the office. Or if so-and-so is elected, the market is going to blow up. Or if so-and-so is elected, the market is going to do really, really well. So let's just look at some data to really get a sense of what does it mean in election years? What has it done in the past? And does it really matter who is elected as president as it pertains to overall market growth? So election years have historically generated strong returns. And this is relatively true. Stocks have had a positive return in 20 of the last 24 presidential election years. So think about that. If you look at the data, whether some of those are Republican and Democrat, what this is saying is it really doesn't matter. Election years typically are going to have historically generated strong returns, which is really interesting because when I talk to a lot of people will say, man, I got to get my money out of the market if so-and-so is elected because things are going to blow up. And historically, that's not been the case. Second, markets have performed well under both parties. Now, if you are dogmatic about one particular party or affiliated with one versus the other, you may not like reading that, but the data shows that that is true. Since 1936, the 10-year annualized return of U.S. stocks made by the start of an election year was 11.2% when a Democrat won and 10.5 when a Republican won. So what we're seeing here is there's not a lot of difference between whatever party is elected. Thirdly, stocks trend higher over time, regardless of who's in office. All you have to do is look at the data, look at the long-term periods, and you will find that that statement is true. And so we've been here many times before. It seems like every time an election occurs, there seems to be either this gloom and doom, or if the right person isn't in office, the economy is going to blow up. The market is not going to have growth, or it's going to have tremendous growth specifically because a certain person is elected. And what we're seeing is that's just not true. It usually performs regardless of who is elected. Now, potential market impact of the presidential election. Again, you can see on the right-hand side of the screen, what I read earlier is how close it is regardless of who's in office between the Democrats and the Republicans. What the data shows is that the first 5 months of election years, historically, they have lower average returns and higher volatility. And then regardless of the outcome, markets tend to bounce back and return to an upward trajectory following both primaries and election day. So this seems to be the case, again, regardless of who is elected. Now, this is a really interesting slide because we're looking now at the comparison between presidential approval ratings and market performance. And what we see a lot of times is investors really don't need to agree with political agendas to do well in the markets. In fact, what we see is some of the best returns in the market actually happen when approval ratings were somewhere between 35 and 50%, meaning less than half of the population in the country didn't approve of who was in office, yet that didn't reflect in the overall market return. So I make this statement sometimes, and I think it irritates some people, but I would say that who is elected president can have an impact on the market, but I think overall, presidents a lot of times get too much blame and they get too much credit for what happens. So as you think about this election and you start to think about your own financial plan, I would say it's important to stay with the fundamental disciplines that you've established in those plans and don't get concerned who is elected. Stay disciplined with what you have implemented and stay the course and be disciplined with your overall financial plan. Some interesting data doesn't mean that future returns are going to reflect past returns, but typically small cap stocks have historically outperformed large cap stocks in presidential election years. So if that holds true this year and you're someone that's just looking for an opportunity, maybe this is where you go to look for that home run. Doesn't mean it's going to happen. Doesn't mean that it's going to have the same result that it did before, but the data shows small cap stocks in election years is going to outperform large cap stocks. So let's look at the economy and some of the trends shaping in the economic landscape. You can see interest rates looking from the end of 2022 compared to what they are in February of this year. So you can see here that interest rates are up. You can see inflation is down because of what the Fed has done over the last year and a half. And you can also see that the unemployment rate is just a touch up this year from where it was just at the end of 2022. If we look at the state of the U.S. economy and what's ahead, what we're seeing is for the first time in 2 years, there's optimism that's outweighing pessimism among different CEOs that were interviewed. Inflation is cooling, but shelter inflation, as we talked about before, is providing stickier than expected. And so, again, walking that tightrope of what to do with interest rates is going to be something that we're going to continue to monitor. The economic growth is resilient. This is powered by strong gains in spending in 2023. Growth is expected to be moderate in 2024. Projections by the Fed were revised higher than in March. So again, we're doing a shift. The Fed is even making a shift of what they thought was going to happen throughout the course of this year. Unemployment rose in February. It's still below 4%. As you look at consumer finances, household debt servicing ratio remains below pre-pandemic levels. And then retail spending rebounded in February, but fell short of expectations. So again, those are just things that are going to have overall impacts on the overall economy and things that we're going to continue to review. When you look at these key economic and market metrics, what we're seeing is the consumer sentiment is up. Economic growth is a touch down. Inflation, again, is stalling. It's stagnant right now. Volatility is down. Unemployment is a touch up. And then the 10-year Treasury yield is up as well. When you look at the different trends and components, what we're seeing here is that the recent trend in year-over-year U.S. inflation, along with analyst forecasts, is that inflation continued to decline through the first half of 2023, but now it's remained stuck. And again, this is one of those major things that is going to impact the overall market and the overall economy. And here you can just see the chart that shows the historical real GDP, as well as the most recently reported economic growth projections. This is a really interesting slide because we talk about the U.S. national debt. You hear about this. You hear about the underfunding of different government programs. And when you hear the number that's the size of the debt, it's so big that you really don't get a feel of what that actually means. So when you look at what 1 billion, let's look at that little square at the top of the slide. If that represents what a billion is, then you can look at what a trillion is. And so right now, the U.S. debt is over $34 trillion. And I think we look at that and we talk about it, and it's so overwhelming and we're not even sure what to do with it. But what I would say is how it relates is how it's going to pertain to taxes in the future. And so when you think about taxes, if you look at this and you say, well, realistically, if the debt load is that size and programs are underfunded, then more than likely my taxes are going to go up. So you want to make sure that as you're planning, you want to plan appropriately for how that's going to impact your overall financial outlay. And then the last two things that I want to go over is, okay, well, what does that mean for the average investor? What does that mean for the average person that is either getting ready to retire or they're in retirement? Well, the first thing is if you've worked with us for any amount of time, you know we talk about bucket plans. We talk a lot about sequence of returns. And so what you see here in this slide is you see two investors that each invested $500,000 into a portfolio and started taking a 4% withdrawal from that $500,000 in retirement. And what you see here is the impact of what we call sequence of returns. So that person on the left had negative years, 3 negative years in the first 6 years. And because of the start of when they were taking those distributions, the negative impact where they ran out of money compared to the person on the right. So one of the things that we talk about all the time is to make sure that when you're taking distributions, you want to avoid taking those distributions during down years. And there's strategies that we can help implement to help you mitigate that risk. So as you're getting ready to retire, or if you're in retirement, this is one of the key things that we talk about is avoiding sequence of returns risk. Now, on the flip side to that, if you've worked with us and we talk about bucket planning, we talk about that later bucket. We talk about the importance of long-term investing. And what happens in so many instances, especially in an election year, where people get spooked, where people think, I need to take some money out of the market because I don't want to lose it if the market goes into a recession. So this is an interesting graph that I think is helpful that shows investor reactions to the 2008 financial crisis. So especially when you look at those top 3 lines, you look at the gray line, and this is an investor that moved cash at the start of 2009 and invested it just 1 year after, compared to the steady investor that stayed the course, making no changes, and even after the 2008 crisis, continued to invest, and you can see the difference of what a $10,000 initial investment. And then for somebody that was really optimistic and really took advantage of that. Not only did they leave the initial 10,000, they invested an additional 10,000 at the start of 2009, and you can see the impact of what that meant. And so what we feel really strongly with is if you create a good bucket plan and you plan for a sequence of returns, which we talked about before, the rest of that money can be invested long term, and you will be rewarded if you stay the course. So if you have any questions about anything that we talked about, or you want to explore some of those things in more depth, be happy to talk to you about those. I know some of those were just over on the surface, but we can dig into those a little bit more. We can talk specifically of what that means to your plan. We'd be happy to do that. Please reach out to Rose in our office, and she'll be happy to set up a time with one of us here to talk you through it. Really appreciate your time today. Thanks for making time to hear this information. I hope it was helpful for you, and I look forward to talking to you next month at our next monthly webinar. Have a good day, everybody.